Palmer and I'm Lead Portfolio Manager of the Sustainable Portfolios here at LGT Wealth Management. And I'm here to give a bit of an overview of what has been going on in our portfolios through the course of Q1 of this year. After a particularly challenging investment backdrop through the course of 2022, 2023 has actually started on a much more firmer footing, particularly through January and February, although markets did start to recede through the course of March, particularly on the back of the financial or questions over the financial system instigated by the fall of SVB Bank. Pleasingly, our sustainable portfolios have all ended the quarter in positive territory, and it's also pleasing to see that a lot of our equity exposures that have driven that performance, and actually a relatively broad range. Some focus more on those growth areas of the economy with higher exposures to sectors like technology, but also from our more value-focused funds, such as the Schroder Global Sustainable Value, also one of our top performers, generating returns of over 5% over the course of the quarter. Towards the other end of the spectrum, then the majority of funds ended in positive territory, with funds producing less of the positive return, more in the fixed income space. But we're very comfortable with that because obviously the role of those funds in the portfolios is to provide those defensive characteristics. Looking at the changes that we've made through the quarter, then on the fixed income side, we've looked to add some more defensive characteristics by adding some more government bonds in the UK, focusing at the longer end of the duration profile, as we saw an opportunity as yields moved north of 4%, to add an element of protection against the concerns of a possible recession in the UK. We also increased our inflation protection by introducing a global inflation-linked government bond fund. Again, on the basis that the inflationary expectations had started to cool through the beginning course of the year, but they still remain a factor potentially in markets through the rest of the year. So we took the opportunity to gain some more inflation protection. On the equity side of our portfolios, we continued the process that we went through last year of maintaining balance in our portfolios by increasing our exposure to our more balanced value-focused mandates and slightly decreasing the growth end of the spectrum. But importantly, this is a continuation of the work we were doing last year, and we now feel pretty comfortable with our balance in portfolios given the current market dynamics. So if we consider the overall characteristics of the portfolios now, then we do believe we've got a good degree of balance and diversification within them. One of the assumptions of sustainable investing is that it is very much growth investing, and it is true to say that we do have a slight growth bias still in our portfolios, and it is important to say we are still comfortable with that over the longer term given the opportunities we see in those areas of the market. But we would also highlight the fact that around half of our equity exposure is towards more core sectors. So these are the areas of the market which don't necessarily skew too heavily in favour of growth-led markets or value-led markets. And we also have now, after some of the rebalancing work we went through the course of 2022, around 15% of our allocations towards more value-focused elements of the investment spectrum. The style characteristics are predominantly driven by the sector allocations that we have. And we do still have a significant exposure to technology in our portfolios at around 25 to 30%. Again, still very happy with that given the longer term opportunities we do still see in that area of the market. But that also means that we are highly diversified across the economy, with the remaining 70 to 75% of our equity exposures diversified across other sectors, which we think gives us great balance in our portfolios. Looking at the market cap side of the equation, then we do have a leaning or have the majority of our exposures in large and mega cap companies, again, which we think in this current market environment where there is increased uncertainty gives us better defensive characteristics. So overall, we would characterize our portfolios as core with a slight growth bias with a large cap focus, which again, given the current market uncertainty, we are happy with. Two other areas that I would just highlight in terms of the overall characteristics of our portfolios is firstly our focus and continued focus on quality. This gives us, I think, a lot of, defensive characteristics in the current market environment where there are still large uncertainties, but also to pick out specific sort of impact of that is that our companies on aggregate and our portfolio as a whole carry less debt. And we think that this is going to be quite important as we go through a refinancing cycle in the corporate side of the economy with the higher interest rate environment. And the last point that I'd like to make today is when you look at the valuation of our portfolios. Again, if we go back to 2022, then one of the narratives at the start of the year was that sustainable portfolios were very expensive given the huge run up in valuations of a lot of the underlying companies. It's certainly true that our portfolios were following this dynamic at the start of 2022 in terms of a premium to the market. But given the changes we've made and also the moves in share prices, our portfolios now trade still at a premium to the overall market, but a much reduced premium. Again, we're happy to pay a premium for quality and for growth, but I think it is an interesting and important factor that the premium over the wider market is much reduced from where we sat at the end of 2021 and leading into 2022. Turning to policy, we saw several announcements which we think add further support for the long-term structural tailwinds within our portfolios. Firstly, within Europe, in response to the US announcement of the Inflation Reduction Act last year, we saw two acts that are coming to pass. Firstly, the Net Zero Industry Act, which will add a huge amount of support in terms of tax incentives, similar to the Inflation Reduction Act within the EU. And accompanied with this is the Critical Raw Materials Act, which has a more keen focus on the raw materials that will be required to power the energy transition. The numbers are still being finalised, but it's estimated that in excess of 500 billion euros of extra stimulus will be injected into the European economy through these two acts. Within the UK, we saw some more announcements around the green finance strategy. This was a little light in terms of finance commitments, but in terms of the rhetoric, it did further embed the idea of trying to make London and the UK the first net zero finance centre. And again, more from a support and a broader narrative perspective, we think add further tailwinds within the UK. Turning towards the UN, we saw the signing of the High Seas Treaty. And this, after 10 years of negotiations, saw all the UN nations come together to, for the first time, look to protect our waters, both from an environmental and also from an economic perspective. Finally, bringing it more focusedly into the finance sector in this country, we saw an update from the FCA on the SDR proposals, so the labelling system within the UK around sustainable funds. Really, the main takeaway was that they are postponing their next real meaningful update until Q3 this year, but we were encouraged to see that they are looking into and reassessing how the labelling system will apply to multi-asset and NPS solutions. So something there for us all to look forward to towards the end of the year.